Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, 9 a.m. Eastern every Monday morning with the stocks to watch and the stock market news you need to see. And Nation, shares of Tesla are up 37% just in the last 2 weeks, with Rivian up 39% and other EV stocks all getting a boost from strong second quarter sales. Nearly every car maker from Tesla, GM, Rivian and Ford reported surprisingly strong EV sales. It's leading to short squeezes and jumping share prices across the industry, and I think with more upside to go. I'll detail the turnaround in EV stocks and which I'm buying in this week's video, along with important updates for shares of Medical Properties Trust, MPW, and crypto-related stocks, Litecoin. Back to our main topic though, and shares of EV stocks are rebounding with surprisingly good delivery numbers for the second quarter, showing that consumer demand may be on its way back up. Even on that bounce on shares though, most EV stocks are lower for the year, meaning if that rebound turns into a trend, it could still be a very good time to buy these stocks. For example, even after that recent 37% bump, shares of Tesla are still down 10% over the last year and 35% from its 2021 peak. EV truck maker Rivian is down 41%, and ChargePoint, while up 34% in the last 2 weeks, is still down 80% over the last year. Now, much of that sell-off had been on a slowdown in EV sales and a consumer pushback on prices. Sales of EV cars were up 25% last year, which compared to about 2% growth for internal combustion engine vehicles is pretty amazing, but it is well off that 50% plus pace that we saw in prior years, so a slowdown pace in EV sales. The slowdown has investors worried that growth in EV companies no longer supports those higher valuation multiples on the price to earnings, so PE basis, and the price to sales. But over the past couple of weeks, it looks like EV sales may have bottomed and are on the way back up. Nearly every major EV maker posted sales that beat expectations for the second quarter. Powerhouse Tesla delivered nearly 444,000 EVs in the second quarter, which was down 4% from the same quarter last year, but up 15% from the first 3 months of the year. GM reported its best EV sales quarter ever with over 21,000 delivered, up 40% from last year and up 34% just from the first quarter. Kia said its EV sales doubled in the first half of the year to 29,392. And BMW hit a major milestone, reaching 1 million deliveries with Q1 sales, up 28% over 82,000 from last year. Now compare this data with overall U.S. vehicle sales, which were up just 0.6% in the second quarter, and it is again apparent the EV transition is still happening for consumers. Ford reported sales for its internal combustion engine vehicles, those traditional vehicles, was down 5% in the second quarter versus last year, while its EV sales jumped 61%, led by the Mustang Mach-E. Now pair all this with the news of the Rivian-Volkswagen partnership last week, which will see VW invest $5 billion into the EV maker to develop Rivian's architecture and software platform, and we see an industry committed to that transition. So let's start with some of the EV stocks I'm buying, starting with ChargePoint Holdings, ticker CHPT, and then we'll wrap it up with shares of Tesla. ChargePoint accelerated into gains Friday, and it looks like it may be triggering a short squeeze, at least in the near term here. Longer term, while I doubt we get back to that $7 plus price in the stock we saw last year, the upside to $3 or $4 per share is within reach. That's because charging infrastructure remains the big bottleneck in the EV transition, and ChargePoint is a strong leader in this theme. Tesla fired its entire charging division team in April in a spat between Musk and its supercharging team chief, so growth in this EV charging market could shift abruptly to names like ChargePoint and EVgo over at least the next couple of quarters. ChargePoint also signed a major partnership with LG Electronics last month. It's going to see LG using the company's software across its commercial network, as well as integration into the LG home charging platform. LG is a giant in consumer electronics, and this adds to the biggest story for ChargePoint, that of its growing and recurring subscription revenue. That recurring revenue jumped 37% in the most recent quarter and was 36% of the total revenue. Now, over time, that revenue is going to keep growing and could be as much as 46% of total sales, boosting the top line even if new software sales growth slows. We see in estimates, ChargePoint is forecast to post 27% revenue growth next year and to reach EBITDA profitability. The company has no debt due until 2028, which gives it all the runway it needs, and shares are attractively priced at just 1.3 times revenue. I like EVgo, ticker EVGO, for many of the same reasons, though I think ChargePoint still holds that competitive advantage in scale. I highlighted EVgo as a potential short squeeze candidate in a recent video. The share is already up 12% since, but still with 31% of the stock still shorted. That could give it further to run as those shorts run for cover. EVgo is expected to book much better sales growth of 55% this year versus less than 3% for ChargePoint, though it is off to a much lower base. I do think you can own both of these since that upside for both is tied to that macro level picture for charging infrastructure, and both should do really well. I've owned shares of Rivian Automotive, ticker RIVN, since March of last year, and while the performance has been disappointing to say the least, I still believe the company is reaching an inflection point on its profitability. Management has confirmed its forecast for 57,000 production units this year, and orders have already topped 68,000 for the 2026 rollout of the R2. But understand the worry, and really the price drop over the last year, was if Rivian would have that cash flow to make it to that 2026 launch without significant debt and share issues, but that recent partnership and $5 billion cash infusion from Volkswagen really clears that up a lot of those fears. The EV truck maker is simplifying production for its new model, removing over 100 steps, and has reported a 35% reduction in costs. That and a lower selling price to boost sales could help Rivian post positive earnings soon after that rollout. Among the legacy automakers, Toyota Motor, ticker TM, has done very well on its balanced transition to hybrid and EV models. The Japanese car maker reported EV hybrid sales up 63% to almost 250,000 cars in the first quarter alone, and 40% of its total Q2 U.S. vehicles. The shares of Toyota trade for just 9 times on a PE basis, so that price-to-earnings basis, well below the 63x valuation investors pay for Tesla. So here you're looking at that exposure for EV growth story, but at a reasonable valuation. Now here, while Tesla would have been that go-to EV investment in the past, it's not the pure play it once was. Shares trade for a price-to-earnings of 63 times, about 27% discount to last year's PE valuation, and way below the peak year in 2021, so that price could rebound further if the company can continue to improve those deliveries, but I kind of wonder if Musk hasn't taken his attention away from those core EV sales. Musk has been vocal, going to the X platform to talk up the company's Optimus robots and robotaxi news over the past couple of months, while the company has withdrawn its public target for selling 20 million EVs by 2030. Investors are waiting for that announced robotaxi news August 8th, and Musk has recently pondered that Tesla could be worth as much as $30 trillion when it completes that pivot from EVs to humanoid robots and robotaxis. The CEO has also announced that next year could see a return to EV sales growth with its new low-cost model, so it is possible that, especially if we really do hear something that moves the needle on those robotaxis in August, that Tesla is the stock to own here. The shares are benefiting from momentum right now, but it's going to need more of that news to keep going. With valuation where it is, though, I still prefer some of these other EV stocks like ChargePoint, Rivian, and EVgo, maybe Toyota on that hybrid story. On to the stocks I'm watching this week. First up with Delta Airlines, ticker DAL. It's going to be reporting its earnings on Thursday, with the airlines not really benefiting from record summer travel in the U.S. The TSA was expecting to screen over 32 million travelers in the last 2 weeks, a jump of 5.4% from last year. Travel has rebounded since the pandemic, with traffic through U.S. airports higher than any time in the last 5 years, but the airlines just haven't benefited from that, with the U.S. Global Jets ETF, that's JETS, down 33% since pre-pandemic, and only up 3% this year. A shortage of pilots and other crew is weighing on profitability, with EBITDA margins at U.S. carriers down from 2.5% for United to a plunge of 16% in profitability for Spirit Airlines. We'll see on Thursday, but Delta may do better on its earnings than others, with the CEO telling CNBC last week that the airline saw its performance levels accelerating with the best first quarter in reliability ever. Delta does have the best on-time record among the major U.S. carriers. The carrier is expected to post a drop of 11% in earnings to $2.36 per share, even as it grew sales by 5.8% over the quarter. Full-year earnings are expected higher, though, to $6.61 per share. That puts the shares right at about 7 times on a price-to-earnings basis, which is well under the historical average around 9x PE for this stock, a potential 28% upside if the company can improve investor sentiment. Medical Properties Trust, ticker MPW, is down 30% from its mid-May recovery, though shares are still up 33% from the January low. Recent pressure has come on a delay in the auctions for some Steward properties. The bankrupt hospital operator chose to delay its bids to July 18th just to give bidders a little bit more time. That delay also follows news that Optum was backing out of its purchasing agreement for Massachusetts hospitals, so investors are just worried that Steward might not get as much as expected for its auctions. What I'm thinking here, though, it could be another opportunity to dollar cost lower for MPW investors, with the July 31st sale hearing approaching. Steward should be able to pay back much or all of its loans to MPW, and the sale is going to put tenants in those properties that can pay the bills. We're seeing progress in profitability for hospital operators that should help support rents, and with that Steward sale, MPW is more diversified in its tenants. Now, MPW is expected to produce 96 cents in funds from operations this year, putting the shares at just 4.3 times on that price to FFO basis, well under the 13x average for healthcare REITs. We saw crypto stocks plunge Friday, with the Bitcoin touching a low of $54,000 each, its lowest level since February, on fears that a wave of selling over the next month could be coming. Chartered exchange Mt. Gox reported it has begun repayment to creditors of what could total $9 billion in Bitcoin. The German government also announced it started selling some of its 50,000 Bitcoin seized in the movie piracy operation Movie 2K. The government sold 3,000 BTC Thursday, worth approximately $175 million, but still holds 40,000 BTC, worth more than $2 billion. While a lot of the crypto-related stocks clawed back some of their initial sell-off on Friday, the group is down over the past few weeks, with Riot Platforms, RIOT, really holding up best, down just 1.5%, Marathon Digital, MARA, down 5.5%, Coinbase, COIN, down 12%, and MicroStrategy, ticker MSTR, down 24% since early June. Showing you that bigger picture idea here with the SectorSpiders.com sector tracker. 6 of the 11 stock sectors closed higher last week, with tech, consumer discretionary, and communication services really carrying all the load here. In fact, it was all the Magnificent Seven once again, with heavyweights like Tesla up 27%, along with Apple and Meta up 7% each. The 7 largest tech companies accounted for 1.89% of the 1.96% total weekly gain in the S&P 500 index, so were it not for just those 7 stocks, the S&P wouldn't really be up much of anything. That's why many investors, if they don't have that overweight in that Magnificent 7 stocks in their portfolio, don't really feel like stocks are really in a bull market. Looking at a longer-term trend here, energy stocks' loss of 1.1% last week was kind of interesting given that the price of oil climbed 2.7% and looks like it might stay higher for longer. Energy stocks are up 7.5% over the year, the 6th best sector of 11, and far underperforming tech returns. Now, investors may want to get a little bit more bullish, though, as the sector does look cheap here, trading for just 12 times on a price-to-earnings basis. That's a 22% discount compared to the longer-term average of about 15.5 times PE for the stocks in that sector, and one of only 2 sectors besides utilities that is trading at a valuation discount. Summer travel in the U.S. has been very strong and is likely to continue to draw those crude inventories lower, keeping the price of oil high. With most oil company production break-even right around $40 to $50 a barrel, we're likely to see significant increases in dividends paid through the second and third quarters at least. So be watching for that, and stocks like Diamondback Energy, ticker FANG, and Devon Energy, ticker DVN, when they report their earnings. Looking at the stock market news for this week, second quarter earnings start with the banks on Friday and should show profits that justify that 16% run in stocks this year. Analysts are expecting companies in the S&P 500 to report an 8.8% increase in earnings, along with revenue up 4.6% higher from the last year. That's well above the 5.9% growth we saw in the first quarter, and really building to an average 11% increase expected for this year. Now, that strong earnings growth wouldn't make stocks cheap, but it would go a long way to justifying the bull market. Stocks are now priced at about 26 times earnings companies have reported over the last 4 quarters, the most expensive they've been since October of 2021. If we do end up seeing that 11% earnings growth this year, though, that lowers the current PE ratio to about 22.8 for the market and keeps that bull market alive for the next year, when stocks are expected to post 14% earnings growth. We'll also see the Consumer Price Index, or the CPI measure of inflation, on Thursday, though it's not expected to have moved much from last month. Expectations are for the headline inflation to have increased 3.1% from last year. That's down marginally from 3.3% pace last month, but if it does come in as expected, it would be the lowest report of the year and really touch close to that psychologically important level of 2% range. Now, what I'm thinking here and why this is very good for stocks is not that I think it's more likely to come in at or under expectations, so slower inflation, but the upside to stocks is likely higher than the downside is for another disappointing report. Inflation has been persistently high all year, and I think investors are somewhat numb to it, so even a report as high as 3.3%, matching last month's pace of inflation, may not really affect stocks that much. On the other hand, a report of just 3% or below would have investors dancing in the street on hopes for that rate cut as soon as the Fed's meeting this month. You'll also get special perks like insider access and free courses. But don't wait, the share sale is only open through July 11th, and shares are selling out fast. Don't forget to tap that subscribe button and click the bell notification so you don't miss a single episode.